not going to give a full discussion of money here. We're just going to skip right to talking about money creation in the banking system. But the definition of money that we want to use is M1, which is made up of currency and demand deposits or checking accounts. So we want to use this narrow definition of money, things that can directly be used in exchange. So we can obviously use currency to buy things. We can also just write checks, do it electronically, just transfer funds from one account to another. And we can also use that directly in exchange. And then we have over here a balance sheet, which you can look at for any company and would show assets or things that the company owns, and liabilities would be what this company owes, usually debts to someone else. And we want to look at particularly what a bank's balance sheet is going to look like. So in my example, we're going to assume that there's $100 out there in currency to start out with. And in my simplified example here, we're going to assume that once this gets deposited in the bank, everyone's going to be fine just keeping their money in the bank and just writing checks. So you can just transfer that money to anyone else without ever having to use cash. So we're going to start with this deposit and then see what happens in the banking system after this deposit. So here we have this deposit over here, which for this bank is a liability because they owe this depositor the money. It would be an asset for the person who has this account, for the depositor. It's a liability for the bank. And then once it's deposited, so we can imagine this $100 is just going to go into the bank's vault, and we call that bank reserves. So that's an asset. Just cash would be an asset for any company, so that's an asset for the bank, but it's offset by this liability because it's not the bank's money, so it wouldn't have any net effect on this bank's net worth. And we're really only concerned with tracing what's happening to assets and liabilities here. If assets were greater than liabilities, this bank would have net worth, and once it starts making some money, that would add to its net worth, but we're not going to be concerned with that here. So we have this $100 deposit. So now we still have $100 in M1. The money supply is still $100. It's just in the form of a deposit rather than currency. And so notice we wouldn't want to count bank reserves as part of the money supply because we're already counting this $100 deposit. So we wouldn't want to say the money supply is $200. Now it's still $100. We have this $100 deposit. This person could just transfer funds out of this account into someone else's account, never having to use cash if they don't want to. This is a demand deposit, meaning they could withdraw this cash. They could demand this money at any time. But again, for now, we're going to assume that they're not going to need to do that. So right now, this bank is just storing this money. And if that was all a bank did, it would essentially just be a warehouse, and this person would have to pay this bank to store their money. But the reason why a bank is going to make money and why they might even be willing to pay interest on accounts is that they're going to use this money to lend out. So we have this $100 in reserves, and again, in my example, we don't have to worry about withdrawals. But if we did, then we'd want to hold some of them in reserve just in case this person wanted to withdraw their money, even if there was no legal requirement. But there is a legal requirement, so you have to hold at least 10% of your deposits in reserves, and we're going to assume this bank is going to maximize its profits. So it's going to be fully loaned out. So we're going to lend out that additional money, those excess reserves. Any reserves above the legal requirement are excess reserves, and we're going to lend out all of our excess reserves is the assumption we're going to make here. So we're going to make this loan of $90. And again, for a bank, a loan is an asset because this is something of value. It's now a claim on this stream of income that's going to be paid back to them with interest. Again, we're not going to worry about the interest payments here. So it's an asset for the bank, it's a liability for whoever takes out this loan. Now, as soon as this loan is made, this bank has now created money. And this is going to end up again back in the banking system. We're going to assume, like I said, that people are happy to just hold deposits and write checks. And so as soon as we're going to make this loan, we're going to assume maybe it changes hands a couple times, but it's going to come back into the banking system and end up as a deposit somewhere else in some other bank, let's say. So as soon as that loan is made, we have now increased the money supply. The money supply is now 190 in our example. Again, this person can still write checks on their account without ever having to use cash. So I can just say, all right, I want to buy something for $100, just take that money transferred out of my account, put it into someone else's account. We never have to use cash for that. And now someone else just borrowed that $90 and now has an account with that. So that is money. So M1 has increased as soon as we made that loan. This is a fractional reserve system, fractional reserve banking system. So banks are only holding a fraction of their deposits in reserves, and so that allows them to create money. Again, this loan of 90 becomes a deposit over here, and it could become a deposit in the same bank. That would be fine, but we're going to assume that it's in a different bank. So the same thing happens here. We're going to hold 10% in reserve, and we're going to lend out the rest. As soon as we make that loan, we have increased the money supply. And let's just do one more. That loan becomes a deposit somewhere else. $81, we're going to hold 10% of it, we're going to lend out the rest. So as you can see, we can keep going, and we're continuing to add to M1, and theoretically we can have an infinite series here, but it's not going to be an infinite amount, so we have to sum this series. So here's our series, and we're going to rewrite it as $100 to start with, and then remember, we're going to lend out 90% of that. We're holding 10% and we're lending out 90%, and that's what creates the new money. So we have 0.9 times that original amount, and then we're going to have 0.9 of that. So multiplied by another 0.9 gives us 81, and again over here, so that's the series that we want to sum here. So this turns out to be a geometric series which takes this form. Up here, this is in general if we have a series of this form and x is between 0 and 1, which it is going to be in this case. In this case, x is 0.9. That will sum to 1 over 1 minus x. So if you haven't seen this before, you're just going to have to take that as given. And so we have this series, which gives us 1 over 0.1, which is 10. And so that's what gets multiplied by this initial amount to get us $1,000. So this sum, if we were to sum the theoretical maximum of this infinite series, we would get $1,000. And so this factor that we're multiplying here, this 1 over 0.1, or what that is 1 over the reserve ratio. So our reserve ratio is 10%. We were assuming we were holding the legal minimum, and so the money multiplier in this case is 10. So that initial $100 got multiplied into $1,000 of money supply. And remember, we're assuming that it's all staying in the form of deposits. No one's trying to withdraw anything. So just to review, we started in this case with $100 in cash, so there was already $100 in the money supply. We put that into the banking system. So initially we put $100 in reserves into the banking system, and that got multiplied through that process that we just saw into $1,000 in deposits. So reserves support deposits. And in this case, because we started with 100 and we ended up with 1,000, we had $900 of new money. So the banking system, on top of that $100, ended up with $1,000 of money supply. 900 was new money. So remember, we initially put $100 in reserves into the banking system, and then what we did was spread that reserves out among different banks. So 10, 9, 8, 10, so you can see it's 1/10 of that series here. So that would add up to 100, because remember, we assume no one's withdrawing any money from the banking system, so all those reserves are still in there. So we have $100 in reserves, $1,000 in deposits. So again, reserves support deposits. If we have this amount of deposits, it must be supported by 10% of that in reserves, assuming that we're lending out all of our excess reserves. Another way to think about it is that original amount of excess reserves. Remember, $100 got deposited, $100 in reserves, 90 of it was excess because we had to hold 10%. Excess reserves get multiplied into new money. So $90 of excess gets multiplied into 900 of new money, and then we added that original $100 to get that $1,000. So it's just another way of saying the same thing, of what's going on with our money multiplier.